That's kind of where I am now, is I just identify trends just like a surfer floating out past the break. And what are they doing? They're sitting out there waiting for waves to roll through the market. And every year there's about 5 to 12 waves that roll through a group of assets that I follow. You gotta understand position and risk management. You gotta manage positions, and people don't know that. They don't know they'll average. I don't average down anymore. That's how I blew up my account, which was trading futures. And I had blown up one account with futures. And once I got the new one open, several months later, I took a big break because it broke me mentally. Boring makes money. And if people don't like boring, which they don't, then they go to the stuff that's all flashy and they get sucked into strategies. And unfortunately, that's just the way this circle works. I mean, I've been in the newsletter industry for 25 years, and it is unbelievable how many different services and newsletters come out with crazy cool spins. I'm like, oh, that is a good marketing angle. They're going to suck in so many traders.
Welcome to the Alpha Mind podcast, where we explore the human aspects of trading, risk-taking and risk management in financial markets. Our podcast is proud to be sponsored by the Society of Technical Analysts, the STA, a superb organisation committed to trader education through top-tier courses and diplomas. As an exclusive offer, our listeners can access the STA's outstanding home study course at a discounted rate. For more details, visit alpha-mind.net. We are also thrilled to announce the opening of our High Performance Trader Development Programme to the wider trading community for the first time ever. For nearly 15 years, Alpha Mind has provided versions of this program to leading hedge funds, investment banks, and commodity and energy trading firms, helping professionals at leading trading organisations to enhance their skills and transition into high-performance trading professionals. The program includes 10 live interactive Zoom sessions, each lasting 2 hours, focusing on the mental, emotional, and personal challenges faced by traders in the uncertain world of financial markets. Whilst most trader development focuses on the basic skills of trading, the High Performance Trader Development Program focuses on the attributes needed to excel as a trader. Led by Alpha Mind's very own Mark Randall and Stephen Goldstein, this program is limited to just 25 participants and runs from March through to June 2025, with sessions on Monday evenings after the UK and European Trading Day. Participants will engage actively, sharing experience and exploring key concepts together in these sessions to help deepen market understanding, to help improve trading processes, and to work on managing emotional and personal challenges. For more details, visit the STA homepage at technicalanalysts.com. Then click on the Education tab, then the STA Courses tab, and scroll down to the High Performance Trader Learning Program. Now, on with this week's podcast. So welcome to this week's Alpha Mind podcast. And Mark Randall cannot be with us today, so it's just me doing the interview. And we're delighted to have Chris Vermeulen with us. Have I said it right, Chris?
Yeah, pretty good. Vermeulen. Yeah.
Vermeulen, sorry, it's Chris Vermeulen. So I'm delighted to have Chris Vermeulen with us. Chris, well, maybe you can tell our audience all about you, Chris.
Sure, yeah. Well, thanks for having me on the show. Long story short, just like a lot of pro athletes, I started at a really young age as a teenager. I got stuck in the equities markets in a finance class in high school. This was back in 1997, and it was a stock market challenge about can our classroom make more money than the other schools? And it was just play money, and we ended up making about like $180,000, something like that in a semester. Back then, all the symbols were in the back of the newspaper, and we'd all just kind of pick one that had the coolest looking name or whatever our theory was back then. And that kind of got my teeth wet. I was saying, holy cow, in one semester we made that much money. I'm like, who needs to go get a job? And I'm an introvert, so I naturally am like, I don't really want to go out into the wild and have to talk to people. And it wasn't long after that course or that school class that a booklet came in the mail that my dad got from Larry Williams about trading futures. There's a little thin paper booklet. I read that thing over and over and over and begged my dad. I'm like, let's start trading futures. We can make like $50,000 a week trading pork bellies and all that stuff. And of course he laughed. He's like, no, you keep learning, but that's not what we're going to do. And fast forward a couple of years, I got into college, and my roommate happened to be making websites. He was a web and tech guy. And I said, hey, listen, I want to learn the stock market. I want to share what I learn and make a group of people online. Let's build a website and a business. And we did. We built a booming business around me just sharing what I learned. I communicate with other traders, and here I am almost 26 years later, still doing the same thing. And I share everything that I do, and I share the trades that I do. But I have gone full circle. I used to initially trade small cap stocks and penny stocks. I used to trade a lot of covered call strategies, buying stocks and then selling covered calls on them. I traded Forex, and I day traded futures, and I used to run day trading rooms and day trading futures rooms. I've done kind of every kind of way there is to trade, because that is just the way I am. I'm like, I want to learn and try everything and then figure out what I like the best and what works with my personality, my lifestyle, the amount of capital that I have, because during different stages in your life and different amounts of capital, and different strategies kind of work for different people. And I've come full circle to be like, okay, fundamental to me doesn't really work. I've lost a ton of money trading fundamental analysis. Even if the companies are growing, even during a bear market, the companies still get cut in half and then get cut in half again. You're down like 70%. And that was when I stumbled across John Murphy in about 2001. He's like the godfather, obviously, of technical analysis. And I have just put everything to use. So I'm a 100% technical trader, and I manage positions. And it's all about, it's not trying to predict when something's going to turn. We can usually see when things are getting oversold or overbought, but it's about being able to follow the trends, ride the coattails of the actual trend, and identifying if the trend is actually something that has legs behind it, strength, or if it's just a bounce and noise. And I look at the market fairly different, I think, than a lot of people. Maybe not your group, because you guys are based around technical analysis, which is, I think, key. Is I view the stock market like the ocean. When the tide goes up, all boats go up. When the tide goes down, they all go down. The stock market, to me, is the same. When it's going up, you can kind of throw a dart, and most stocks are going to go up. During a bear market, when everything's going down, there's no point in holding any stocks. And this is where I really differ, is I just don't believe in holding a whole bunch of sector ETFs and a bunch of individual stocks. If you're in a bear market and they're all going down, why hold any equities? Why don't you move to a different asset class that's going up at that time, or take advantage of falling pricing? And so that's kind of where I am now, is I just identify trends just like a surfer floating out past the break. And what are they doing? They're sitting out there waiting for waves to roll through the market. And every year there's about 5 to 12 waves that roll through a group of assets that I follow. And we hop on those waves. We can identify that they're strong. They're a nice set of waves with power behind them. And the nice thing about riding those waves is when they're super strong, you also know when they're starting to weaken, and we get out of those. And that's where I've come full circle. It's very, very simple, very laid back, 5 to 12 trades a year. We're just catching nice rolling swells through the stock market and through the bond market and currencies, whichever asset's in favor. And that's where I've kind of gone, is from aggressive, fundamental, all the way through to now it's like super passive technicals. Just ride the swells. Let the waves come to us. Don't go hunting for them.
So thank you for that. That was great, that introduction. There was a lot there. Really interesting that you've tried lots of different methods. You've dipped your toes in lots of different approaches. You know, one of the things that, as I'm listening to that, people like to label traders as a certain type of trader. Would you label yourself a trend follower? Would you label yourself a technical trader? Or is there another sort of categorization that you would give yourself, just to help people understand that's where you're coming from?
Yeah, I mean, I'm kind of a mix of all of them. I'm definitely a technical trader. So I use technicals to identify trends, but I trade to trends. That's what I'm looking for. There's those trends in the market. So I would say I'm more so of a trend/position trader, right? So I'm not a buy and hold, set it and forget it, ride the roller coaster. I'm not an active trader. I'm really kind of in between, which is actually kind of a term that I coined as an asset revester. I actually wrote a book on this. And instead of doing nothing and buying and holding or being super active, because generally the more you trade, the more likely you are to lose money. That's just unfortunate realities of trading. It's very difficult. Is I take my capital and I reinvest it into whichever wave is rolling through an asset at any given time. So I call it asset revesting, and it's trend following. We actually sit in the markets about 35 to 40% of the time of the year. We're sitting in cash. waiting for a wave to roll. And then, so we have very little risk. A lot of times when chaos hits, we're not even in the markets. We'll be sitting collecting daily interest, waiting for that wave to come through. And then we hop on that swell and we ride it. So it's a nice way to naturally always be in a very neutral, safe position. And then when we're in something, it's exciting and it's a strong, steady trend. So yeah, definitely trend following strategy.
Okay, and I can see you've got the book behind you called Asset Revesting, just appearing over your shoulder. Of course, our audience can't see us, but tell us a little bit more about that term, asset revesting, because you gave us a nice introduction.
Yeah, so asset revesting, it's we'll get into maybe personality types, because I think knowing your personality type is really important as a trader. And about 81% of personality types don't bode well if you manage your own money. But we can touch on that later. But the book is designed about identifying these waves, only holding assets that are going up in value. If nothing meets our technical criteria that it's in a strong rising uptrend, we just don't go in anything. We'll sit in a cash position like BIL, which is it's pretty much a type of cash. You just get paid daily interest and a monthly dividend. It's an ETF, but a money market fund is the same type of thing. And so what this strategy focuses on is an asset hierarchy. So we have a hierarchy. What's at the top is the most volatile. So we have the US equities indexes. We naturally want to be in those because they're the most volatile and we have the most potential to make money. So if there's a wave rolling through those, we want to take advantage of it. If they don't meet any of our technical criteria and risk management, then we'll look at the long-term treasury bonds. If they don't meet our criteria, we'll look at the US dollar index. And if that doesn't meet our criteria, then we just sit in cash. And as we go down each of those different assets, from equities to bonds to currency to cash, the volatility, the risk drops dramatically. They all become less and less volatile. And so typically as the markets get crazier, like the stock market and the economy, we're scaling back to slower and slower assets to kind of counter the chaos in the world, but still take advantage of a rising trend. And so while the stock market could be free falling, like in 2022, the stock markets fell about 25% or so. Well, UUP, which is the US dollar index, it rallied about 18% in that year. And the biggest pullback of the whole year was less than 4%. So it is a very low volatile, nothing to make you sweat, but you can catch these beautiful trends that rally in a slow asset class. There's nothing better than watching your account grow for months while the market's collapsing and everybody else is, getting shaken out and panicking. And we're in something that's so slow, but so consistent. Currencies are beautiful assets to own when all hell is breaking loose everywhere else. And so asset revesting, the whole theory is, how can I make the most money with the fewest amount of trades with the lowest risk? And so that's what our asset hierarchy focuses on. That's how our position managements, we're all about taking profit targets, scaling out of winning trades, because the market always cycles through. Eventually there'll be another pullback and reset, and we can re-enter even if it's the same asset. And so that's what we do, is just find an asset that's moving up. Preferably, it has to the highest one on the hierarchy so that it has more volatility, more potential. And we just rotate, reinvest into each asset as it becomes favorable.
Okay. And as a question, you say we invest. Are you running other people's money, or is it just your own money?
No, it's just my own money. Yeah.
Right.
Yeah,
okay.
I say we as in I've got a company, I've got a team that helps me here. So we help others. So I manage my own money, and every trade that I do is what I issue to subscribers, followers of my technical analysis newsletter. So they just ride my coattails. I ride the coattails of the markets. Everybody just copies my trades. And yeah.
Okay. And you mentioned a few things, the personality aspect's really interesting. I want to ask you one thing though. Are you trading using leverage, or are you investing using capital?
I don't use any leverage anymore. I used to.
Right.
When you're younger and you swing for the fences, typically if you have a smaller account and you really want to grow, people like to naturally apply leverage. I've blown up 3 accounts in my lifetime. The last account I blew it up the same day it was funded and opened. So I have learned my lesson on risk. That was back when I was futures trading. This was back in my 20s. And I've also lived through a bankruptcy. So I've been to the top and then all the way to the bottom again. And so that all of those really whipped me into shape in terms of leverage and Now things are different. Now I have the lifestyle I want. I've got a family and kids. I have quite a bit of wealth, and I want to manage all of it very easily I say conservative, in a consistent, protective way. And so now I focus on the ETFs. I don't use any leverage, but I know a lot of subscribers, people who copy what I do, they'll use the 2X or the 3X or trade options on my signals. So everybody can go blow their brains out with as much leverage as they want. But if you're managing, your lifestyle, like your life savings, generally you don't jack up. I don't anyway. I'd rather grow my account slow and steady and consistently than try to swing for the fences. I don't need to swing for the fences. It's not like I'm trying to hyper growth an account while I'm young to try and get ahead. It's more so like I just want to not have any panic when the markets move or rotate and just continue to grow and have no concerns there.
That's a lovely approach, and something which doesn't get talked about a lot in trading, this idea of leverage against using capital. But it's still trading. It's not really... Would you say? I mean, you use the word asset revesting. It's a strange word, because when I talk to people, I work with a lot of clients. Sometimes they'll tell me they're investors. Sometimes they'll tell me traders. Quite often they sit in a gap in the middle bit, which I call active investors. I don't mean active investors in the sense of buying 5% of a company and trying to steer the company in a certain way. I mean, they're in and out of investments all the time, almost like traders, but they're not using leverage. They're applying an amount of capital, so they can sit with drawdowns a lot longer because they're not using leverage. They can sit with trends. They don't get disturbed nearly as much by noise. They don't get thrown out. It's a lot more considered way. I mean, it's a lot of people don't realize how much the leverage in a trade owns them, or they're even not aware that they're using leverage when they're using margin accounts or futures accounts.
Yeah, for sure. I mean, and it really varies on the individual. Like a lot of people who will put on a position, like you said, where they'll hop into a company, take an ownership, and they'll try and steer the company, or they get into something. It's generally a chunk of their wealth. It's not everything. A lot of traders will put in like their whole trading account into a trade, and so they're living like tick by tick, watching their life value go up and down. But as more of a savvy investor, somebody who has enough capital will go say they've got $3 million. They'll be like, I put $250K or $100K into this company, and they're comfortable with letting it fluctuate because it doesn't even matter if it went to zero. It's not changing their lifestyle really, right? So it really comes down to position sizing. And this is something, so I used to sell a course on like position management, risk management. Nobody buys it. You can almost give it away and nobody will even take the course because nobody wants to talk about it. Everybody goes, I'm going to buy NVIDIA today. And they have no idea. They're like, I'm just going to buy whatever 100 shares or 500 shares, or I'm just going to buy $40,000, whatever it is. They don't pick anything generally like that. They're like, okay, if it falls 34% like it did in August, what's it going to do to their account? But most people put on position sizes way bigger than they can actually stomach. And I mean, people just don't have common sense or logic. It drives me nuts in the markets. And that's why the markets are so volatile, is people just go from like greed to complete fear because they get greedy in something, it goes the wrong way, and then they're freaking out and they're panicking. And you gotta understand position and risk management. You gotta manage positions, and people don't know that. They don't know they'll average. I don't average down anymore. That's how I blew up my account, which was trading futures. And I had blown up one account with futures. And once I got the new one open, several months later, I took a big break because it broke me mentally, the stock market. But I'm like, I love the markets. I have to get back in. But my problem was I got into futures. I got into a simple losing trade with one ES mini contract, and it went against me. And I'm like, okay, it looks like it's going to bottom. And I'd buy another one. I just kept averaging down. And by the end of the day, the market just kept selling and falling and falling. And I kept adding and adding, expecting. I'm like, any bounce and I'll be able to get back to break even. I just need a tiny bounce before the end of the day.
Oh, God, yes.
And instead of that bounce, at the end of the day, the market just went straight down even more, and boom, margin call, everything gone in one day. So I don't average down anymore. Anyway,
it sounds like a good idea at the time.
Yeah. All you need is a bounce, and you're set. You're golden. But if you don't get it, you're toast.
Do you know what? Coming from where I am, coming from where I am and sort of 40 years in the industry and doing what I do now, when you told me about that course that you tried to sell and no one was buying, I was thinking, you're selling them the secret and no one was willing to purchase it. They all want the answer.
Yeah.
They all want, where's the video going tomorrow? What's Tesla going to be in 3 months' time? And you were giving them actually the source code almost to how you succeed in this. And like you say, you couldn't give it away because the source code is that risk management, position management, sizing. It's not where's the market going.
Yeah, 100%. People, I run the newsletter now, and we'll get out of a trade and people will be like, well, I still like it. I'm going to stay in it. And it blows up and it backfires. And it's amazing how emotions take over. People just refuse. We did a survey with our followers. We had about 5,500 people fill out a survey last year. And we asked a bunch of different questions, but they all are asking dancing around the same kind of question, just totally phrased in different ways and from different angles. And it's like 99% of people, emotions is their biggest problem. They don't want to take a loss. They want it. They think it'll come back. It's just, they feel like they're missing out. They're too scared to get out in case it bounces. Like there's always a reason to stay in a trade, and they hold on to ones that are down, 50, 60, 80% for 10 years.
We're going to go back to the podcast in a second. Just first, we want to tell you about a new initiative we are doing with the Society of Technical Analysts. Alpha Mind will be delivering our first high-performance trader learning program, and it's going to be delivered by myself and Mark Randall next year, starting in March 2025. This program is based on over a decade of successful performance, coaching programs and workshops delivered by us at some of the world's leading hedge funds, some of the world's top investment banks, and several of the world's top energy and commodity trading firms, as well as to serious-minded professional traders, including several who featured in Jack Swagger's most recent Market Wizards book. You can find out about this program by going onto the Society of Technical Analysts website at the link technicalanalysts.com and then going to their education page. As we said, this is a 10-week program delivered on Mondays, UK time, between 6 and 8 p.m. It's going to be delivered live over Zoom. Enrollment is limited to just 25 participants. Now back to this week's podcast. For me, it's really interesting because, the emotions are just a symptom.
Yeah.
And you were selling the cure, which was actually get your risk management right. Everyone repeats that. Yeah, we know it's about risk management, but I always say, we could write a book on risk management, and I don't blame people. No one would buy it because even I would fall asleep at page 2 by then because it's not sexy, but it is the source code. It is. That's it. I tell people, right, and I don't know what your returns are a year, but I say, do you know how much you'll be worth if you can generate 20% a year on your capital and you reinvest it every year and can average 20%? Have you got any idea how much that'll grow to over the next sort of 15, 20 years?
It's ludicrous. It's
just at 20%. Which is not for someone working on their own from home with a trusted process. That is achievable. Even with a tiny bit of leverage, maybe with none. Okay, even 15%. It will grow, and
it's huge. Compounding is the most powerful force in the planet, right? And you just nailed it. So I got my POTS license when I was 16 years old. So I grew up, checklists. I got the checklist strapped on my leg, and I remember going for my solo flight. My instructor, when I showed up, he's like, "Chris, hop in the plane." He's like, "You're going up for your first solo." I remember my heart dropped. I remember my mom, because I couldn't even drive a car back yet. I wasn't even of age, but I could fly a plane. I remember when my instructor said, "Chris, you're doing your solo today." I looked at my mom. I was scared, and I looked at her, and she was even more scared than I was. She's like, "Oh my." But I remember taking off, and as soon as I took off on the plane, and I kind of calmed down, I flew past the end of the runway. I'm like, I need to figure out what's going on here. And I just looked down to my leg where the little checklist was strapped down. I'm like, I've done this 100 times. All I have to do is just each little step through this checklist, and I will be back down on the ground, a pilot. And so I brought that forward to everything I do. Everything I do is systemized, and now it is like watching paint dry. So we have 5 to 12 trades a year, which is not very many.
Yeah.
We see the trades coming usually several days, sometimes like a week in advance. We're like, okay, it looks like we're about to get one. And we also know when one's about to end. And so there's no huge surprises. And it doesn't matter once we're in a trade, it doesn't matter what the market does. We already have the trades and the orders in place. It doesn't matter. Everything's then taken care of. And so it takes away all of that emotion. As soon as it's systemized, and you're like, it doesn't matter what happens. Either I take a small loss or we keep running up and keep building our accounts. It becomes really boring, and nobody likes boring. And so like our accounts, we're averaging about 14% a year, and that's no leverage. And every couple of months, our accounts are hitting all new all-time highs. And people still complain saying there's not enough trades. It's really boring. I'm like, what are you talking about? I'm like, once we're in a trade, I mean, you can bug off. You can go enjoy summer. You can go do crafts, arts, and whatever you want, hobbies, right? Like go do stuff. You don't have to sit at the computer. Like stop being like an addict to trading. But people need that action, and people will break the rules. Like we'll have this strategy and they'll be like, well, I got out and I moved over to something else that's moving faster, or it's just, people drive me up the wall when it comes to
it's an addiction. And I've been there, you've been there. We're human. Okay, we want excitement, we want the thrill. But it's really interesting to listen to people like you, people like Peter Brandt, who, I always remember listening to one of his interviews on Chat with Traders. And, he just said, my job is to make what I do as boring as possible.
Yeah.
And if I can do that, I'm going to make money.
Yeah.
And that was it. And, we had Pradeep Bondi on a couple of episodes ago talking about the same thing. When he started, he went big. He took big swings. He's not afraid of risk. But he said, he would have these massive drawdowns. And he said, it doesn't matter who you are. That just rips your kind of emotional, stability to bits and frays you. And then he discovered a way to do the job where he just goes, making singles, just keep knocking singles.
That's it. Well, if it's boring, it means you have a system in place and you're not running on adrenaline because you don't know what's next. When you have a system in place, you're just like, okay, I know exactly what to do next. If this keeps selling off, we're getting out. If this rallies to here, we're going to sell some, take some profits and move our stop up. Boring is what it works. Boring makes money. And if people don't like boring, which they don't, then they go to the stuff that's all flashy and they get sucked into strategies. And unfortunately, that's just the way this circle works. I mean, I've been in the newsletter industry for 25 years, and it is unbelievable how many different services and newsletters come out with crazy cool spins. I'm like, oh, that is a good marketing angle. They're going to suck in so many traders. But it's a rotating door. I mean, they're just satisfying what people want to hear and want to feel, but they don't.
Truth is, though, I mean, in reality, it's not boring. It's just boring compared to what people think it's going to be. It's that. Yeah. I mean, I used to, some of my best trades going back to my trading days were just sitting there waiting, trying, cutting out, didn't work, waiting, trying, cutting out, didn't work. Wait for the next one. Suddenly something happens, you read a signal, you feel something, you go in, knock it on, then let it run for 4 weeks, hits the target, take the profit off. Now that
is amazing.
It may sound boring. It made a lot of money, and it was really exciting at the time. And, I always remember on the day after what I called a very best trade I ever put on, where I was maxed out risk-wise. And I went to watch tennis in London. It was just let the trade in. The stops are in place. The trade's on. It's working. I'd been invited, by someone with tickets, and I didn't look at to be honest, we didn't have mobile phones then, but we did have pagers. But, I didn't look at a pager all day. I didn't even take it with me. I just called the office once. Now, I can tell you what happened that day. That day, there was a big, sharp correction at one point in the day. And had I been at my desk, I may have panicked and cut out.
Right.
It ended the day on the high, I was long, so it ended up on the high. But funny enough, sometimes being too close to the action is what causes trouble. Sometimes you need to be there. Sometimes you need to step back. I think I was reading one of Jesse Livermore's quotes last week. There's a time to be long, there's a time to be short, and then there's a time to go fishing.
Yeah. And that's what I focus on. I mean, I do a lot of different stuff. I like to live life, not sit at a computer. I've done the sitting and staring at screens and intraday charts. The whole strategy I have is all end of day. It's very, very laid back. I don't need to watch the charts at all, as you said. And what you said was your best trade, and it's fun, is exactly the way I see it. I'm like, to me, this is the best strategy possible. I mean, we have the fewest trades. We make great, consistent returns year after year. And you can go and live life. You do not have to be glued to the screen. You don't have to sweat bullets. If the markets go down, we just simply exit because we've got strategies in place. And the people that I help now, really, I've completely pivoted away from traders. Now I'm just helping people close to retirement or in retirement who have wealth, who value consistency, compounding, and they want just low volatility, but they want above average returns. That's what I focus on. And they don't care about the intraday stuff. They just look like, I have an auto trading program. So if you don't want to trade it, it'll execute already for you in your own brokerage account. So it's kind of like we manage money, but we don't. It's the brokerage system will execute the trades. But I love it. They we'll see the market pull back and people will be like, I was scared to open my account to see how the strategy did. And they're like, how did we make money? The markets went down. Like, people are like shocked, right? And so that's who I'm trying to help, are people who want to preserve their lifestyle and wealth. And they're not watching the intraday chart. They'll check in every now and then, but they trust the system. They know, everything that goes on with the strategy is for my money. I build it for my own capital. So it has your best intentions. I don't want to lose money. If I lose money, you lose money. So we all kind of work together as a team and kind of just trust each other. And I do what I can as well as I possibly can.
So it's a lifestyle choice.
Yeah.
And I'm just going to add something else in there, because it's something I tell a lot of people that trade for themselves. It sounds like you have another source of income, which is selling a service. And it's something I try and tell an awful lot of people. If you're going to build a career in trading, you need to last the learning years, the learning period. And it could be really good to have another source of income, because markets are not always going up. Your P&L is not always moving forward. You're not going to grow it if you're drawing down on it all the time. You need to reinvest it. And I do recommend people, if they could find a way, whether it's they've got an ability and understanding in a market, something they can sell. A lot of people, I'm not talking about sort of the guru subscription services we see everywhere that just sell a trade idea and are rubbish. But there's an awful lot of people that have got an awful lot of value, an awful lot of knowledge out there, can provide great research, can provide signals that sell services. And what I say is, try and be one of those, try and have, for example, I used to work in a bank, or for 25 years I used to work in banks, and I used to be a trader there. Now, if I had a bad year, which I did have every now and then, sometimes too many, I still got paid. In other words, why would they pay me as a trader? Well, I was providing a service to them as a trader. It didn't always work, but they needed traders. They needed people to run their books. Therefore, I was getting an income. They know you're not always going to make money. I was getting paid as an employee. Obviously, I don't get the same payout from the money I make as if it was my own money. It's the same in hedge funds. People get paid in hedge funds. They don't always make money. But the hedge fund doesn't want someone sitting there who's worried about every tick. Yeah. They want someone who can know they're getting paid, so they can sit back and allow a process, a strategy to pay out over time. Mm-hmm. And the very worst If they don't make money that year, they can still live. They're not going to draw down, and maybe the next year they're going to make money because they've got a process. No process makes money every single year or makes good money every single year. It just doesn't work like that. It's called risk. There's a game of reward, but risk means sometimes it's going to go against you.
Yeah, I think you make a great point. I mean, I think it's all about having multiple streams of income. I mean, I'm big into multifamily real estate. I have self-storage facility. I've got all kinds of different things on the go that kind of purr in the background that are managed. And of course I have the subscription. I share my insights, my kind of education, my signals. So I have multiple streams coming in, which really reduces the risk of, if a trade doesn't work out, well, I'm still getting paid from renters and all kinds of stuff on the side.
Yeah.
So I think it's very important for everybody. A lot of people move into trading and they quit their job and they're like, I'm going to trade, I'm going to make a living, just as you said. And it's not that easy. I believe everybody should have some type of passive income. Find something you're good at or have a little side gig, at least so you have a little paycheck coming in, because the markets are very, very difficult. And the more active you are, the more difficult they actually become. And this is where I navigated my strategy is, how can I do all the things that I like, do multiple different jobs that everything I do, I'm passionate about. So I don't really see them as jobs. They're more like, they're all stuff I love. Like they all generate money. They're all investments. They're all kind of, steady. Find something a strategy that allows you to do those. So my strategy that I share is end of day. I don't get a signal until everything closes and all the different data feeds we have to attract money flows between asset classes and figure out, is the tide going up or down? Is this a huge swell of money moving in one direction or the other? So I have all day, every day to do whatever I want. And then in the evening at 4:00, I can jump on and be like, okay, we have no signal, or, oh, it looks like we're a couple of days away from potentially getting one. Or like the last trade we had gotten out of earlier this summer, I said, we have no trade for sure for a minimum of 2 weeks. So go enjoy summer, go chill, I'll still do my updates. I will keep you in the loop, but you do not need to worry, go enjoy. So don't get into, like, people just get into day trading. I was just at the Toronto Money Show. I was there for 2 days teaching a workshop on trading and investing, and everybody wants me to teach them how to day trade. And I'm like, just don't do it. It's just get a part-time job or something and focus on swing trading, something that the trades last a few days to several weeks or a couple of months, or position trading, trend trading. And so you're still making money and you're still comfortable living and all that stuff, but you're learning to trade on the side, because it takes decades to learn to trade and it never ends.
That's the bit. You said at the beginning that you tried all these different methods. You tried fundamentals, you tried technicals, you tried different types of technicals. You tried day trading, you tried it. It is a multi-year learning process. We've got to try different things and find what we like.
And you have to find something that fits your personality, right? Like, I don't want to day trade. To me, that's a job. I mean, it's fun for a while, but and everybody's brain, just as it doesn't matter. Everybody sees things differently. So the way I see the market, what my little nuances and the way my brain ticks, I pick up on things that other people just don't even see.
Yeah.
And that's my sweet spot. Other people will pick up on individual stocks or options, or their brain ticks differently, and they have a different personality and they want to trade more aggressively or whatever. So everybody has their sweet spot. And that's what you were just kind of saying. Everybody's got some cool insight that if you follow the markets long enough, you could turn it into some type of newsletter or some type of shared community and turn it into a revenue stream, because everybody sees the market and they have their own life experiences that allows them to perceive the markets and get some insight in some way. The question is, how good is that edge, or how many of those do you have? Can they all piece together? Can you work with others to create like full strategies? I mean, it's really amazing, right? In terms of how that works and how I see the markets. I mean, I share with other professional traders who do exceptionally well, and they're like, yeah, I don't know how you do that. I don't see that. I don't feel and get any of that stuff. And that's just because all of our brains perceive data and pick up on nuances totally different. And that's what makes the market. Yeah.
Completely. And, you mentioned personality, and this is such a big field. And, I'm just going to point listeners back at this point to our episode 49 from July 2020, I can't believe it's that long ago yet. We called it the Risk Personality episode with Jeff Trickey, who wasn't a trader. He created one of the tools I use when I coach clients, which is called the Risk Type Compass. And it's a brilliant tool. And it's you take a questionnaire and it uses the 5-factor formula, which is used in most personality tests, and it identifies people by different risk types. How people take decisions under high risk scenarios. And it's not just used in trading, it's used in lots of areas. I use that and I see different personalities suited to different types of trading. For example, the sort of individual who's going to be good at running an options portfolio is not going to be good at day trading. And vice versa, the guy who's really good at day trading is, and they're probably going to be more of a market maker than someone in a prop trading role. But someone who's really good at that is not going to be good at options trading, where you need to sit back, you need to sort of build a portfolio, you need to look at that bigger picture, and you can't just go in and out. You have to allow things to play out. Likewise, there's some people who are much more creative around their trading, and other people who are much more prone to following a systematic approach. Again, some people are bigger picture, some people go into very sort of detailed, either systematic approaches. Some people are much better at trading off the top of their head. Other people need a lot more structure. And everyone has a different element to who they are. And what we find is that there is no personality that cannot succeed at trading. We've seen that over the years. Every single personality type can succeed. What they must do, however, is trade in a way which suits their personality, trade in a way which aligns with their personality. And that is more important than anything. If you're trading an approach which doesn't suit you, it doesn't matter, how great your analysis is, how great your process or your strategy is, you are just not going to trade it well.
Yeah.
But if it suits you, you've got a massive edge.
And for sure, it doesn't feel like work. It's not, you're not constantly, grinding the markets away. Actually, the first book I wrote years ago called Technical Trading Mastery, 7 Steps to Win with Logic. I have a section on trying to figure out your trading personality. What type of trader are you? What are your risk tolerances? Once you figure these things out, what asset classes are best for you? Like what instruments? Are they stocks? Are they options? Is it leveraged? Is it, whatever, all those different things. So I explained it in there. In fact, I actually did a presentation, a 2.5-hour presentation to the Canadian Society of Technical Analysts here in Toronto area, and presented all that. And it just as you said, you need to understand your personality. You need to. I'm a big fan. I go and I try all things, and then I'm like, okay, which one felt natural? Which one did I like? Which style of trading? And then that was the direction I went with my personality, and that's where I am now today. I just trade ETFs. I only trade the indexes, bonds, currency, and cash, and I move all my portfolio into whichever asset is arising at any given time, and that fits my style, my available time, what I want to focus on, and. So and the other thing is that we haven't really touched on is every asset class, every stock, every commodity, every currency, whatever it is, has its own personality. And a lot of people just play the same strategy on the same thing. And it's like, okay, well, if you're trading, the VIX, you need a very different strategy because it moves totally different than gold. And, people trade individual stocks and indexes with the same strategies, and volatility changes. There's a lot that people don't realize. You should learn a couple things exceptionally well, nail them down, and then expand to another. Some people just specialize in trading Apple shares, and they're really good at it, and that's all they do. So you need to. People get caught up with what's in the news, what's moving. I got to go buy some. Versus like, who cares what's in the news? Why don't you nail something that's fluid and consistent and has nice movements, and you understand that stock or that sector or that asset class inside and out, and then you naturally trade it. And once you've got that nailed down, then you say, okay, Well, I also like this. I find it actually moves at a different time than this one. And before you know it, you've got 5 or 6 strategies and different assets that move differently at different times. And you're literally just moving from one asset to another, and they're all controlled, and it feels comfortable instead of just, being stuck in one thing or being spread out on all kinds of random stocks that are popping and dropping. And you're always like, another one didn't work out, and this market's scammed, it's rigged. And if you don't understand something really well, people naturally think that there's like, oh, the news killed me. I'm like, well, it's not always just news or insiders or manipulation. It's actually just probably the way that asset moves. Occasionally, you need to know it's part of its characteristics, and you just think, you're just instantly blaming it on something else.
It is so true. Become great at just a few things. Become amazing at a few things. Yeah. That is something that I'm a big believer in. Specialize. And they can be related, and there were things that are related to it. I had a really strange relationship with sterling rates and sterling yield products, sterling bonds, gilts, when I was a trader. That I sucked at them. But I was great with bunds. I was great with German government bonds. I was great with euro rates. And it's really weird. Why should I be great at something that is so similar to something else? And maybe I was just too close to sterling. I lived in the UK, and maybe that sort of proximity to it clouded my judgment. But I had a similar thing between the Aussie dollar and Aussie dollar rates and the loonie and Canadian dollar rates. I was dreadful at Canadian dollars, but I was really good at Aussie dollars. And they were two kind of, sort of commodity currencies. So why should I be good at one and not the other? But I just understood the personality of one and didn't get on with the personality of another. Mm-hmm. For some reason. So it was, in that case, steer clear of one and stay with the other. There's no point going there.
Yeah. Sure.
And it may have been different for other people who may have had completely the opposite sort of personality. And you might get the same with stocks. You just kind of gel with something. You like it and it likes you, and the other one doesn't like you at all. So, stay away from it. Don't try and get it to like you. But these elements of trading, they often get forgotten. But you need to feel comfortable with something. You need to know something. You need to have this thing about personality. And when I try and use a metaphor that helps people understand it, I often think of, say, athletics and the metaphor of the body. If you're built powerfully and you decide you want to be an athlete, you want to do an event that suits a powerfully built athlete, because you're naturally likely to be better at it than if you do an event that's not really built for your body shape. For example, you wouldn't want to be a marathon runner because they're usually quite lithe, quite light-boned, and you can train as much as you want, but you're never going to compete with somebody whose body shape is naturally built to run 26
run with
miles.
The wind.
Yeah, but that person who can run 26 miles, it doesn't matter how much they're going to train, they're never going to be a great 100-meter runner. They just don't have the power and that they can train as much as they want. They're never going to compete with people who are powerfully built in those sort of events. And for me, it's a similar thing with personality, and trading. You have to find something that's suited to your persona, I suppose you could say your life experiences almost, that's helped shape the person that you are. Before we finish, there was a few things which I just wanted to ask you, because I guess some people are going to be coming on for some trading technical analysis tips. And you've obviously formulated your style off of that. What is it that, if someone was going to take away sort of maybe 3 key technical analysis tips from you, what would they be?
Yeah, well, there's a couple. So the first one is I love Fibonacci extensions. I don't know if people use those. So
you're talking my language now.
Yeah. So here's how I set up Fibonacci extensions, and it works with any asset, any time frame. I use the Fibonacci extensions, and I use the 0.618. So that's the first upside target. And then I use the 100%. So that's it. I get rid of all the other ones. And I find if price runs up to this 0.618 and it pauses and pulls back for a little bit, then you almost always go up and hit the 100% measured move. And that means the momentum and the timing is nailed in. We use it all the time. It is so powerful. It is great for day trading. It's good for swing trading. Even the 20-year gold chart just hit its Fibonacci extension. It just paused for a couple of years at the 618. This is a 20-year pattern. And now it's extended up and it's just hit that 2700, which is the 100% measured move. This is going back to 2003 lows. So that is like one of my favorites. It's great for day trading if you're active and want to be kind of aggressive that way too.
So just to clarify, I was more into Fibonacci projections, which is a very similar thing. The Fibonacci extension, just to make sure I understand it, where you're coming from, is where you take the move from the low to the high, and then you extend it by, say, 0.618 or 1 times that move from the high or from a pullback?
From the pullback low. So you'll grab the low, and then you go up to that rally high, and then it'll give you one more click that you click down to the pullback low. And then it'll automatically extend up 0.68 of the previous leg and 100%. So you need a little bull flag or a little pennant, like a little pause to get that low.
That is the same thing I was talking about, but I always used to call it a projection, and I would call an extension. So this is one of the interesting things about terminology. Sometimes we use different words for the same thing, but I would call an extension where you take the move from the low to the high and then you extend it higher. But what you call extensions, I call projections. That's why I was kind of getting quite excited. And I would I would find that short-term moves did quite well with a 1.618. Longer-term moves I would find better with a 0.618. But again, I was using more leverage type trades in my own trading.
Right. Yeah. The only reason I call it Fibonacci extension is because I use software, eSignal charting software, and I just put my mouse over it here just to see it, and it calls it a Fibonacci extension. So that's the only reason I call it. I bet you John Murphy's got a different term for it. Yeah. But yeah. So that's So that's one thing. That's one golden tool I use all the time.
Brilliant.
The other is a combination to probably make up the other three. So I love the 20-day moving average.
Okay.
I love the 5-day moving average. And a really cool way to do it is if you can just code your 20-day moving average to be when it's sloping up, it's green. When it's sloping down, it's red. Then it tells you if the underlying trend is up or down. And you want the 5-day moving average above the 20-day.
Right.
And then you're naturally in a good trend to the upside. When the 5-day flatlines and breaks below the 20-day, that is also an indication that kind of wave is over in the markets. And I love it when I focus this mostly on the SP 500. I find if you can identify and nail the SP 500 trends, the rest of the markets are fairly easy because they all move in sync together more or less. So I love it when the 5-day moving average is above the SP 500 is above the 5-day. It'll naturally want to stay above it. It'll pause for a day or two and then pop above it and run. So those are like good ways to take advantage. If it's above the 5-day, the index, you're in a high momentum play. If it pulls back towards the 20-day, you're in like a nice swing trading type of low. And the key is to make sure both of those moving averages are sloping up and that the 5-day is above the 20-day. But I find those are amazing ways to just identify some trades. I use a lot more other things that go into it. I track money flows in and out of different sectors and commodities. How much is the money flow going into defensive sectors and which defensive sectors or commodities, and how much volume flow? Is it just like a little stream, or is there like huge money moving to safety or huge money moving to risk? They could be moving into small caps or micro caps. And so that's kind of like the underlying currents of the ocean. I track all kinds of different money flows. And so when we have a new trigger, say to buy the SP 500, a new uptrend starts, I go and I look at all the currents. I lift the hood and I'm like, okay, we have money flowing in all of these directions out of all these defensive plays into these. And if it reaches certain levels, we're like, okay, this is a real swell. There's commitment in this. Let's hop on this trend and ride the coattails because somebody's committing, or like there's a lot of commitment on this trend. And so that's telling us it's a wave. It's a real set that we want to jump on and ride. So I track a lot of that. I think you mentioned right at the beginning of this, a lot of people use technical analysis at such a basic level. They just throw some indicators on a chart, and most indicators are based on all the same data. Like it's all price action generally, or volume. So you get that analysis paralysis. A bunch of them are saying buy, the other ones are saying sell. So I take things into what I call, and I talk about this in my book, Technical Trading Mastery, inner market analysis. It's like a 3-dimensional view. So I look at price action, I look at time, and I look at sentiment. And the sentiment I get from understanding money flows. So now I have a 3-dimensional view of the market. Everybody generally looks at indicators and chart patterns. That is like 2D, as basic as it gets. But then I blend in time, multiple time frames and cycles. And now you've added in a time thing. And then I add in sentiment saying, where is the money moving? Because where the money is flowing to is where we also want to go. So, and that tells us the sentiment of individuals, they're bullish or bearish. So that 3-dimensional view is where we get our accuracy, and we can identify these waves. Like instead of just seeing a chart pattern and being like, oh, hopefully it breaks to the upside, we like see the whole picture. We're like, holy, look at this giant tsunami of money flowing into this asset, and this is a real deal. Let's get in. And then it'll muscle its way up. Our average trade lasts about 40 days. So these are pretty nice swells that come across in these assets. And those are the ones we want to catch.
So that's fascinating, because the thing missing, like you say, liquidity and sentiment tells you so much. And if you're not following that, if you're not tracking that, if you're not thinking about those things, and you're just looking at price in its raw, to me, you're missing. You're only seeing a part of the picture.
Yeah.
Okay. So for me, you're not doing a value interpretation, but you're doing a kind of what is going on interpretation. What is actually happening?
Yeah. And what is the direction and how many people are committing to this? How big is the stampede like behind the scenes running into this asset?
Yeah, that's fascinating. So it's telling you the current. So to me, that is liquidity as well. The current picture that is out there, and then you're using Fibonacci extensions to identify where it may go to, or risk reward, or are you just using trend following?
Well, generally, depending on the asset, we already have kind of targets and our risk management kind of woven into different assets. So it changes depending on the index or the commodity we're trading. I'll use Fibonacci extension for short-term trades, discretionary trades, or just to draw out, say, guys, look at this is what's happened. Here's the next 618 target. It happens to be just, past our first target price, which is perfect. So we should hit that one. And if it does break through there afterwards, our next target is actually a lot of times when you use Fibonacci, it's like our price targets and Fibonacci seem to align. And they also align with previous peaks and troughs on the charts. Everything is so well balanced when you understand how the markets move. And so I just usually use that as a visual, because what I'm doing is I'm hand-holding a bunch of investors. Most people get super emotional. Whenever there's a volatile day, I'll do an afternoon update, say, listen, or even in the morning, I'll be like, you're going to panic today. I can see panic outflows. We've got all our panic selling indicators are going to spike, which means I know you guys are nervous. The market's going to open up sharply lower. We love gaps to the downside in a rising trend, because gaps get filled. Markets are probably going to shake everybody out at the open and then rally up. And so all I'm doing is really just letting everybody know it's okay. This volatility is good. A lot of times when they're scared, I'm like, guys, turn it around. This is awesome. People are bailing out, and the shares are getting put into the hands of comfortable investors. And so that's what I do, is I just kind of help everybody with the Fibonacci, and I draw on the charts, where we should expect a pause and a pullback, and don't freak out when it pauses. This is what we want. We want it to pause, because then it's going to go higher. So, yeah.
I mean, just what you were saying about, you get these levels, these support and resistance lines, these, 0.618s, perhaps previous retracements, and they all seem to come together. I always call them clusters. Yeah. And I used to draw the cluster levels on charts. And if there was a move, a trend happening, I used to feel very confident that we were going to hit these cluster levels, or very confident that we were going to hold above a certain pullback level. And, that set the tone for a lot of my trading. And I would often use those cluster levels to take profit or partial profits.
Yeah.
Because quite often they'd move past there, but they wouldn't hold past there. And then liquidity would collapse and they'd go very quickly back through them. And I was no longer in them, so I wasn't getting hurt from that now corrective move. People had held, but didn't know where to get out. And are now sitting there, giving back money. But I was comfortably out at those points, even though there was a little bit of maybe some tinge of regret that I didn't stay in there. I always kind of knew that those were the levels to get out and don't worry about it.
But that's where the success is, right? It's a bunch of first base hits, and if it doesn't follow through, you get the rest out at break even or so. And that's the thing is, like, once we get to a cluster or we get close to a target where the indexes naturally stall out after a first trend reversal, we trim off profits and we move our stops up. And a lot of times, that first level of that cluster level, a lot of times just turns into resistance and the price goes straight back down. And you'd be like, thank gosh, I took some partial profits and moved our stop up. We made a small profit. We're back in cash. We'll wait for a fresh wave. And that's what a lot of trades are, because a lot of times price doesn't break resistance. But if you don't do it, you end up holding on to it and you go for the full stop of loss versus taking a small profit and break-even exit on the balance, because people don't identify these clusters or these areas where the charts should run out of some steam. And so wherever that is, the first level of resistance is usually where we try to put our first target, just below it. Like, we want to make sure we lock in some gains, reduce our risk right away. And then if it wants to keep going, well, go for it. If it rolls over, we'll be like, wow, we managed that very nicely. We protected our capital, and we can live another day.
So what I'm hearing here, what you're saying, what I think a lot of people make this classic mistake, is to think the technical analysis is the trading. The risk management is the trading. The risk taking is the trading. The technical analysis is providing clues for how you want to take risk and how you want to be, how you want to apply risk. But is that, it is not actually the trading itself. And I think, when I was hearing, you say some of the tips that you use, I should imagine that they are part of your process, but they aren't the process itself. And there may be people listening thinking, oh yeah, I'm going to use that. I'm going to take that away. But actually, what you said might not fit their process, because they're perhaps doing intraday leverage trading. And they're not thinking about, how am I actually doing this? How am I taking risk? How am I managing risk? How am I sizing?
I think you nailed it. I think a lot of people think technical analysis, trading chart patterns and breakouts is trading, but it's not. Trading is actually managing the position, putting it on the right amount, moving your stops, like taking partial profits, knowing where to take partial profits before it rolls over. 100%. People they get into a trade, they're following the charts, and they really don't know what the heck they're doing when it comes to actually managing that position. They just randomly say, I'm going to sell some, or I'm just going to sell all of it because I think it's almost done. And of course they get out and it'll keep going without them because they didn't scale out.
Yeah. And again, I think we've all been there at some point.
Yeah, for sure.
That becomes part of that learning process. That's why it takes time, over the years. Listen, Chris, I could talk to you for hours, if I'm honest. This is really interesting, but we do have to bring this to a close. Can you just remind people again, how can they find out more about you, and what are some of the resources? You've written some books. Where can they go to, give those books a plug, and where they can find you? Give that a plug.
Yeah, sure. So you can find me on YouTube. Just type in The Technical Traders. You can go to my website, which is thetechnicaltraders.com. My book is available on my website, but if you go to Amazon, you can find my two books. One of them is called Technical Trading Mastery, 7 Steps to Win with Logic. That one's obviously based around technical analysis and identifying your risk tolerance, your personality style. And then the one I've just recently published is called Asset Revesting. And that's what you and I touched on today, is constantly just reinvesting our capital into a new wave, a different asset at any given time that's moving up. And it's designed for maximum capital preservation and maximum gains with the smallest drawdown. So for example, the nice thing about asset revesting is we're averaging about 14% a year. We have 5 to 12 trades a year. And our max drawdown since the last bear market top, like back in 2007, 2008, is less than 6%. So we contain our risk on our entire portfolio dramatically. And that's who I'm focusing on, are people who want to, because generally I work with a lot of advisors. They use our strategy for their clients. And they're like, once an account has dropped about 8%, investors, buy and hold investors, get real squirrely and start calling and start questioning things. So I've really created a strategy that allows us to stay well within those tolerances and have exceptional growth, which is the whole point of why we're in the markets, is to make money. So those are that's how you can get a hold of me and learn more about technical trading or asset revesting.
Brilliant. And I will put if you go to the show notes on the podcast episode description, I'm going to put all those details there as well, just in case you didn't get time to catch all that. Listen, Chris, this has been a real pleasure. And, it's great to talk this sort of stuff. I hope people have learned something from today. I'm sure they will have. I just wish you all the best to continue with your success.
Yeah, thank you, Steve. It was a pleasure. It's always fun to talk technicals.
Okay, brilliant. Well, have a great day.
Yeah, you too. Take care.
Thank you for listening today. Again, thank you to our podcast partner, the Society of Technical Analysts. Do check out the offer with regard to their brilliant home study course. If you are interested in understanding more about yourself as a trader, do check out my new book, Mastering the Mental Game of Trading. In the meantime, we wish you the very best of luck and look forward to you joining future episodes of the Alpha Mind podcast. Goodbye.